Low-cost investment option. Index funds are an excellent choice for beginner investors due to their low costs. Since they track a market index, such as the S&P 500, they don't require active management, which results in lower management fees compared to actively managed funds. This makes them a cost-effective way to invest in the stock market. Diversification made easy. Investing in an index fund automatically provides diversification. By tracking a broad market index, such as the S&P 500, an index fund invests in hundreds or thousands of different stocks. This reduces the risk of putting all your money into a single investment, which is especially helpful for beginners who may not know how to diversify effectively on their own. Simplicity and ease of use. Index funds are easy to understand and simple to invest in. For beginners, the concept of tracking a broad market index removes the complexity of picking individual stocks. Instead, investors can simply buy into an index fund that reflects the overall market or a specific sector, making the investing process straightforward. Consistent long-term growth potential. Index funds offer consistent long-term growth potential. Historically, the stock market has shown steady growth over time, and index funds have typically mirrored this performance. For beginner investors, this offers a relatively safe and reliable way to build wealth over the long run without trying to time the market or pick winning stocks. Minimal effort and maintenance. Once you invest in an index fund, there's little maintenance required. Unlike active trading or stock picking, index funds don't require ongoing research or decision-making. This makes them perfect for beginners who want to invest without the time or expertise needed to manage a more hands-on portfolio. Reduced risk of human error. Beginners often make the mistake of trying to pick individual stocks based on short-term trends or emotions. Index funds reduce this risk by offering a broad, passive investment strategy that removes emotional decision-making and minimizes the chances of poor investment choices. Index funds reduce this risk by offering a broad, passive investment strategy that removes emotional decision-making and minimizes the chances of poor investment choices than actively managed funds. Because they have lower turnover, fewer buy and sell transactions, they tend to generate fewer taxable capital gains, which can be beneficial for long-term investors looking to minimize their tax liabilities. Accessibility and flexibility. Most brokerages offer easy access to index funds, allowing beginner investors to start with small amounts of money. Many index funds have low minimum investment requirements, making them accessible to investors with limited capital, and they also provide flexible investment options such as automatic contributions. By investing in an index fund, beginner investors gain exposure to a wide range of industries and companies. This broad exposure helps to spread risk across the market, reducing the potential impact of a downturn in any single stock or sector. This makes index funds a safer option for those just starting out in investing. Proven performance over time. The performance of index funds has historically outpaced the majority of actively managed funds. For beginners, choosing a passive investment strategy like an index fund is a smart decision because it provides a proven track record of long-term growth without the need for active management, making it one of the most reliable options available.